What is going on, everybody? Welcome back to the channel. And in today's video, I want to show you guys a trading strategy that you can use to get into some super profitable trades. Now, before I talk about this strategy, I want to ask you guys a question. Have you ever gotten into a trade only to immediately get stopped out and then have price just go in the direction you already thought it was going to go? Well, I struggled with this a lot in the beginning of my trading career, and in today's video, this strategy is actually going to help you not only avoid having that happen to you, but it's also going to increase your win rate as well as give you a fire risk to reward ratio, so you only have to risk a small portion of your account for a massive potential gain. So in today's video, guys, I just want to give you a brief overview of what the swing failure pattern is, a little bit of theory of why it works so well, and then I want to show you guys some examples on the live chart of these swing failures playing out, and I want to show you guys how you can add this into your trading strategy to increase your win rate. Now, I use this strategy all the time alongside my basic trading strategy, again, to increase my win rate, avoid getting stop hunted, and get a way better risk to reward. And this strategy is the swing failure pattern. So today I want to go over what a swing failure pattern is, how to identify it on the chart. I want to talk a little bit about what's going on behind the candlesticks to help you guys understand what is actually happening. And then I want to take a look at some live examples on the chart, and I want to show you guys how you can actually apply this to your trading to, at the end of the day, just make more money. So guys, here we are on the Bitcoin chart. Now, I have a blank chart here because I want to talk about exactly what a swing failure pattern is and what we can use it for. Now, all the swing failure really is the inability to break above or below a level. So in an uptrend, a swing failure could look something like this, where price is coming up, you try to break out only to get accepted back below that level and continue back down in the opposite direction. Now, if you're looking at support, this would look something like this, where you're in a downtrend, you try to break below the level, and then you only to get accepted back in and continue price in the opposite direction. Now, typically when I'm looking at swing failures, I'm looking at them within a range, but they also work in trending markets really well. So we'll go over both examples, but we can use swing failures not only to find good entries into a trade, but we can also use it to find high probability areas where price is likely to reverse, which is obviously pretty lucrative if you know where those levels are before price rejects off of them. So for example, let's just take a look at a range, right? I'm a pretty big range trader. I love trading using the volume profiles, which basically just gives you a range. And I'm going to go ahead and label these levels. We'll pretend this is a volume profile range. So simply put, you have your range high, your range low, and the midpoint. And let's say price is kind of bing-bonging around, going up and down, rejecting off of the resistance, bouncing off of the support. And for a swing failure pattern, what you're looking for is price to approach a resistance or support level. You're looking for price to wick above that level, only to quickly reject back down and close the candle below your actual level of resistance or support, in this case, resistance. And that is a swing failure pattern. So essentially with a swing failure, if we were looking for a short here within this range, we would be looking for price to break above the level, wick back down, and then close the body of the candle below the level of resistance. And then once your next candle prints, that is a confirmed swing failure pattern, and that is typically what you would use to enter. So essentially what you would do here is you would, after that candle confirmation, you would go ahead and enter your short position and then look to ride this thing back down to the bottom of the range. And simply put, if you're trading a range, oftentimes for me, no matter what strategy I'm using, if I'm trading the range, I am looking to take profit at the POC or midpoint of the range, and then I'm moving my stop loss at that point to break even, hoping that price will continue back down to the bottom of the range. And if it doesn't, and we get a strong bounce off the POC and we get stopped out, you're simply getting stopped out in profit, making it a guaranteed winning trade. And then for a long position, it would look very similar. If you are going to the bottom of the range, you're looking for price to break the low of the range with a wick, and then you're looking for it to snap back up and close the candle above that level of support. And then, obviously, in the exact opposite, you would enter your long position there, your stop loss would go below the wick, and you would simply target the top of the range. And then, again, if you come up to the POC, that would be your take profit 1. And then if you get above, you're expecting to come to the value area high. Obviously, after you take profit at your POC, you would move your stop loss to break even, again, guaranteeing that winning trade. So simply put, a swing failure in the way that I use them is you are basically looking to get a wick above a level and then looking to snap back down and close the candle below that level, right? And then that is your swing failure pattern. Now, why does this work so well? So now that you know what a swing failure pattern is and how to identify it on the chart, again, we'll take a look at the live candlestick chart in a second, but now that we know what a swing failure pattern is, let's talk about why it actually works. Let's talk a little bit about what is actually going on behind the candlesticks. Now, typically with a swing failure pattern, this is not always the case, but it is oftentimes that we see swing failures during a liquidity grab or a stop hunt, which is likely why you're getting stopped out of your trades before price just goes in the direction you originally thought anyway. So let's imagine that you're looking for shorts at the high of this range. So let's grab our short tool. We'll put the short position right here. We're expecting a rejection off the top of this range, and let's say we get in right here. You're probably used to something like this happening, where price just wicks you out and then just continues back down to where you thought it was going to go. So what is actually happening here? Well, we have to understand what liquidity is. And I don't want to freak you guys out with this word. I feel like people kind of talk about this word all the time, but they don't really explain it very well. Liquidity is simply money, right? And oftentimes when people are referring to liquidity when looking at a chart, they're simply referring to stop losses. Because what are stop losses? They're just orders in the market, right? Which is basically just money. And this is not a video about liquidity, but all you need to understand is that price seeks liquidity. Price is attracted to this liquidity like a magnet. And oftentimes, price will look to sweep liquidity before reversing back down and continuing in the opposite direction. So let's, for example, say we're in a short position right here. You have to imagine, if you're looking to short the high of this range, where's your stop loss going to be? Well, likely your stop loss is going to be above a previous swing high, or simply put, above your resistance level. The retail theory here is that retail traders think that if you break above this level, they're expecting to have price continue to the upside. And at that point, they want to get stopped out of their short. So you have to imagine that not only are you putting your stop loss there, but a million other traders are getting into these short positions, and that results in a ton of stop losses being above this level of resistance, right? So you might even have some stop losses from the people who were shorting this bounce off the resistance, right? And this bounce off the resistance. And over time, what happens is you build up all these stop losses above a key level of resistance. And what is that? It's simply just liquidity. And like I just said, price is attracted to the liquidity. And if you don't know what you're looking at right here, the little purple area here is the stop loss on the trade. And then the green part or the blue part is, where you're in profit. Look at all the stop losses that you likely are going to have above these key levels of resistance. And like I said, price is attracted to that liquidity. So oftentimes what will happen is price will get pushed up only to stop out all of these stop losses or stop out all these short positions. And that's where you see that wick to the upside. And then price just reverses back down and closes below that level to reverse price in the direction you already thought. And I know a lot of you guys watching right now struggle with this. And now you know what is actually happening to you. This is you, right? You are the liquidity to come get swept before reversing price in the opposite direction. Now, like I said, swing failure patterns are not always liquidity grabs, but oftentimes this is what's happening, and this is why you're getting stopped out before price just goes in the direction you thought anyway. So how do you fix this? Well, you could fix it with the swing failure pattern, and simply put, a lot of people will tell you, if you want to put an end to the stop hunts, simply just enter your trade where your stop loss would originally be. And although we're not going to do it that simply, that is kind of the theory here, right? But we're not entering on the stop loss. We're actually going to wait for everyone to get stopped out and then enter the trade. And how are we going to do that? We're going to do it with the swing failure pattern. So that is basically what is going on behind your candlesticks. It's just people getting stopped out. And again, price seeks out liquidity. So if you know there's a lot of stop losses above this level, there's likely also a lot of liquidity below these lows. A lot of retail traders are going to have their stop loss right below this range low. And again, if price comes back down, they're looking for longs, but then price oftentimes will just shoot down, wick, close the candle above, stop out all the longs, and then continue back to the upside. Now, before we go on to the live examples, guys, not only are the retail traders getting stopped out here, but you also have breakout traders who are entering new long positions. And what this does is this adds fuel to the move to the downside. Why is this? Well, it's because if people are longing on the breakout, this is why I don't breakout trade, because you don't want a long resistance. But on this wick to the upside, once you break out of that level to the upside, we know it's a fake out, but you have a lot of breakout traders entering into long positions right here, right? You have fresh longs entering the market on this wick. And what that does is it traps traders above this level, right? You have all these people who are longing up here who are now trapped. And what's going to happen is when price reverses back down, they're going to get stopped out as well. And what is a stop loss on a long position? It's simply a market sell. So that's why it adds fuel to the move to the downside. Because if you think about it, if you're longing, let's say I'm a breakout trader and I'm longing, oh my God, we broke out, we're retesting, we're going to break the level. I'm going to put my stop loss right below below this level of resistance. And when price winds up reversing on the swing failure pattern, it's going to stop out all those long positions, creating market sells, which is going to add fuel to the move to the downside. So this is basically what's going on behind the scenes, guys. It has a lot to do with liquidity, and I don't want anyone being confused about liquidity. When people talk about liquidity, they are simply talking about stop losses, right? So now that we have an idea of what is going on behind the candlesticks, why a swing failure pattern happens, and what is actually going on in the order book, let's go ahead and take a look at the actual candlestick chart and look at some live examples. So guys, let's take a look at some real life examples here on the candlestick chart of swing failure patterns. Now, for me, what I like to do right off the bat is if we have a ranging market like this, I like to mark off the high of the range, which would be this wick right up here, and then the low of the range, which would technically be this wick down here. So I will label those levels and I'll mark them SFP, letting me know that if we come up to that level and we swing fail that level, that could be a very, very saucy reversal in the market, and I could make a lot of money off of it. So I instantly mark out the high and lows of the range, but one thing to realize is you can easily swing fail these local levels, and I'm going to show you these examples right now because you actually had quite a few swing failures happen within this price action. So I'm actually going to go in bar replay mode so we could kind of see this play out in real time. So at this point, our range high is right up here, and our range low is technically right here for the moment being. So this, if we come down and swing fail this level, I would potentially be looking for price to reverse, because I know anybody long from right here probably has their stop loss set somewhere below this wick or even potentially below these lows, right? Because I know there's likely a lot of liquidity down here, and even potentially below some of these lows, there's likely a lot of liquidity sitting for anyone who is long. So I know if price comes back down and we wick below this level, we're likely going to stop out people long from here and potentially even people long from down here. So I know it's likely for us to sweep that liquidity, close the candle above here, and then continue back up. But let's see what happens. Let's move the candles forward here, start getting a move down, boom. Look at that. We just swung failed this level, and we broke below the level with a wick, closed the body right above the actual swing failure level, and now all we're doing is we're waiting for the next candle to print to confirm our swing failure. And boom, there you go. Not only do you get a swing failure confirmed with your second candle printing right here, but you also have this nice juicy green candle letting you know that buyers may be showing up here, and the reversal probability is even higher. So this would technically be your long entry. So let's say you get in somewhere in the middle of this green candle, stop loss would go right below the swing failure wick, and then you would simply just use other forms of analysis to figure out, where you are likely to be taking profit. For me, I like to use golden pockets or just the high of the range, but for this example, we will look to just front run this golden pocket slightly, and let's see if you get the reversal. And then boom, you get the reversal. You know that there's a golden pocket here, likely for a rejection, so that would be your full take profit, and then boom, it's a nice little 3 risk to reward for a nice 2.4% move to the upside. But now look what happened here. We are actually swing failing this level right here. We're actually swing failing another wick that was sitting right here. You come up, you wick, you close below, second candle prints. Now we're expecting price to potentially reverse back to the downside. And then boom, we get a move all the way back down to the bottom of the range, essentially. And let's see what happens here. We come back down. We wind up swing failing this same exact level once again. Let's see if we get the reversal back up, right? So if you were trading this, that candle would be your confirmation. Look for a long position. You probably enter somewhere in this wick. Then you're targeting the highs again. Stop loss below your wick low and see if it reverses. Boom. Look at that. That TP is fire. Look at that. So there's a couple of examples of live swing failures playing out in the actual market. This is what they look like in real time. And if you could combine these levels, these swing failure levels, with things like golden pockets, it can add even more confluence and power to this strategy. And remember, these are all internal swing failures. We're really waiting for the holy grail of swing failures, which could be sitting up here. And then you can see this big wick comes up and actually swing fails this wick up here. You tap it, come back down. You even swing failed all of these wicks as well. And now this is making it very likely that we would reverse back to the downside. Boom, you get an absolute nuke to the downside. And then look what happened here. Look what happened here, guys. All this liquidity that is beneath all these lows, everybody who is long from all these lows down here hoping for a big move up, they all just got stopped out on this big wick to the downside, which would make it likely that we reverse back to the upside. So I'm going to get rid of some of these local levels so we don't get too confused. I'm going to get rid of these trades as well, and we are going to see if we could come up there and swing fail this big level up here. So we're starting to approach our swing failure level. At this point, you're sitting here waiting for this price to get broken and looking for your swing failure. You don't get it, right? You actually swung failed this wick from back here. So you actually did get an internal swing failure of this wick right here. You come up, wick above, close below, and you even went up for a second swing failure of that level before getting that big move to the downside. And then finally, we start to make a move for this big SFP level. You get your candle, rips right above. Again, looking to stop out everybody who's short from this wick right here. You come up, you wick above, you close below the level, and that's where you're looking for a big move back down to the bottom of the range. Stop loss goes right above the wick, and then you could target the lows of the range potentially. Or you could even look to target the other end of the liquidity, which is down here on this big wick below. And then once you get that confirmed swing failure pattern, which would be right there, once you confirm this red candle, you would go ahead and enter somewhere on that red candle, stop loss right above your wick, and then you would simply just target the bottom of the range, which would be right here. And boom, you get that super, super quick move. And once again, you swing failed a bunch of the wicks from down here. So you could actually potentially look for another reversal back to the upside. And then you also have a 4 risk to reward ratio there. And that is one of the best things about this strategy, guys, is that you can actually lose a ton of these trades. And all you really need is one of them to play out to cover your losses plus profit. Now, as always, guys, I would never recommend that you just randomly trade these swing failure patterns. You want to use other forms of analysis and other confirmations to make sure you're getting into the highest probability positions. And I'll make another video coming up probably in the next couple of weeks of how I actually incorporate this into my trading strategy and how I use things like Market Cipher and Lux Algo to confirm these moves, making them even higher probability. But for this video, I just kind of wanted to show you guys an overview of what a swing failure looks like on the chart and why it's such a high probability strategy. And as you can see, not only are they high probability, but the risk to reward ratio is also extremely, extremely profitable because, again, you can get into a ton of these trades and lose 3 or 4 of them in a row. And then all you really need is that one big trade to make up for your losses plus profit. So, guys, I hope you have a little bit more of an insight into what the swing failure pattern is and why it actually works so well. And hopefully I answered that question of Frankie Candles, how come every time I get into a position, I instantly get stopped out only to have price reverse all the way back down to where I thought it was going to go originally. And hopefully I cleared some of that up in this video. And like I said, keep a lookout. Probably in the next couple of weeks, I will be putting out a more in-depth tutorial showing you guys exactly how I incorporate this into my trading strategy and how I use things like Market Cipher and Lux Algo to confirm these trades to give it an even higher win rate. So go hit the charts, go into bar replay mode, try to find those swing failure levels and see how well they play out for yourself. And then go ahead and see how you can incorporate this into your own trading strategy to increase your profitability and your win rate. And with all that being said, guys, that's all the time I got for today's video. I'll see you in the next one. Frankie Candles out.
Here we go, at the top of the class on a roll, and it's time to run it up, yeah, you know. Maxed out, put the pedal to the floor, ayy, on the road, here we go, yeah, we winning by a landslide. Never see me coming, I'm a landmine. Yeah, I ain't taking orders in command, like, yeah, you about to see me on demand.